Hello, welcome to today's webinar on the TSP and you. I'm Mark Keene, a certified financial planner located here in the Washington, D.C. area. I'm excited to be here, and I want to thank NARFE for inviting me back again to present today's webinar. Before we get started, I want just to cover a couple housekeeping items. The first is that we are definitely going to be covering a lot of information, but as usual, today's webinar is being recorded and will be posted along with the presentation slides shortly following the conclusion of this presentation. Also, please join us at the end of today's presentation for a live Q&A session which will run for an hour. I'll try to answer as many questions as my fingers can type. So with that said, let's get started. First thing I want to talk about is some basics. And I know it's probably going to be a little bit basic for some of you out there, but through my many conversations with federal employees and retirees, I see that there's a misunderstanding of some of the workings of the TSP and the fund choices. So I think it's important that we kind of dumb it down for a little bit here and just cover some basics before we jump into some more technical issues. So the first thing I want to point out is that the TSP is what's considered to be a defined contribution plan. This is where you're defining the contributions. The agency, the federal government, defines their contributions. But the ultimate value you end up with at retirement and over your lifetime is going to be dependent upon how well you manage it, how well you pick the investment choices, and the returns of those investment choices. So there's no guarantees to how much money you will be provided from this TSP account. Compare that to like the CSRS or the FERS annuity, which is a defined benefit plan, which essentially is a guaranteed benefit that's based on a formula, right? Years of service times a multiplication factor times your high average 3. Now, the high average 3 is the variable that is unknown at this point, but we can do some nice projections and we have a pretty good idea what that benefit's going to be when we retire and over the course of our lifetime. So with the TSP account, you contribute your own money. And today, in 2019, you're allowed to contribute up to $19,000. If you're over the age of 50, you get to kick in an extra $5,000 for a total of $25,000. I'm sorry, $6,000 catch-up contribution for a total of $25,000. You can choose between either the traditional TSP or the Roth TSP, or actually a combination of the two. And we're going to talk in detail about, how do you go about deciding whether it's traditional or the Roth that's right for you. In addition to your own contributions going in, the federal government will do a automatic 1% contribution regardless of whether or not you contribute to the TSP account. They're going to put in 1%. Then they're also going to provide a matching contribution, and it's dollar for dollar on the first 3% of your salary that you put in, and then it's 50 cents on each dollar that you put in for the next 2%. So, for example, if you're putting in 3%, you're going to get matched 100% on that 3%, and then they're also going to put in that 1% automatic. So you'll get a total of 4 from the agency. If you put in 5%, you're going to get the 1% automatic and a total of 4% in matching for a total of 5% from the agency. So that's in a nutshell how the contributions and the limits are going to be working. Now, once you have money in the plan, you need to figure out, all right, how am I going to invest, these contributions and the balance that I have in there? And so for that, you have 5 investment choices. You have the C, the S, the I, the F, and the G. All but the G fund track market indexes. And an index is simply it's a value. It's tracking the value of a group of securities, whether that's stocks or whether that's bonds. And so each one of these funds tracks a specific index and is designed to provide you exposure to a specific asset class. Now compare that to the L funds, which are another choice that you have. And there's 5 L funds, going from the L income and the 2020, 2030, 2040, and a 2050 fund. Those are designed to provide you broad exposure to multiple asset classes, so comparing to the individual funds. In fact, those L funds are simply a combination of those 5 underlying individual funds. And so to understand these 5 funds in a little bit more detail, as I pointed out, they're tracking indexes. And they're designed to provide you exposure to a specific market segment. So, for example, the C fund is providing you exposure to U.S. large companies, right? And specifically, it's tracking the S&P 500 index, which is 500 U.S. large companies. The S fund is designed to provide you exposure to mid-size and small-size companies. It tracks something called the Dow Jones U.S. Completion Total Stock Market Index, and it's actually an index that's of all stocks with the exception of the S&P 500 index. And by the way, there's about 3,500 publicly traded or actively publicly traded companies in the U.S. that are on exchanges. And so if you had a total stock market fund or a fund that tracked the total stock market, you'd get exposure to all 3,500 of those stocks. The C fund gives you exposure to 500 of some of the biggest companies in the U.S., and the S fund is those mid and small size companies. The I fund is giving you exposure to international securities. It's tracking something called the MSCI EAFE index, and that stands for Europe, Australasia, Far East. MSCI is an independent research firm that puts together these various indexes. And it's giving you exposure to, this chart shows 20 developed countries. That's what's posted on the TSP website. But if you go actually to MSCI's website, you'll see that they say it's 21 developed countries. And they're all large and some mid-sized companies in there. So that I fund is not giving you exposure to small company and small international companies or emerging economies. So it's strictly developed, primarily large with a little bit of medium-sized companies in there. The F fund is giving you exposure to bonds. And a little bit of difference between stocks and bonds. When you buy a stock, or you're owning the C fund, the S or the I, which is in turn holding hundreds of stocks on your behalf, you're actually an owner, a small fraction owner of those companies that you hold the stock in, right? And as an owner, you participate in the profits as well as the losses. So when earnings are not going well, stock prices are dropping, and you're participating in that. Compare that to a bond. When you own a bond, which you're doing indirectly through the F fund, you're actually lending an entity money. Right? So you're lending them money, and in return, they're going to pay you some interest for a specified period of time. And at the end of that period of time, they're going to give you your principal back. And so the F fund tracks that Barclays Aggregate Bond Index, which is a combination or compilation of government, corporate securities or bonds, and mortgage-backed securities. So then we have the G fund. As I mentioned, that's the only fund that does not track a specific index, and therefore it's the only fund that you can actually not replicate outside the TSP. You can actually get funds just like the CS and I and F funds outside of the TSP, whether it's in an IRA or brokerage account. But the G fund you cannot. It actually consists of special issue securities from the Treasury Department to the TSP. It's designed to provide interest income based on longer maturity bonds, but with none of the volatility. Stocks are more risky than bonds, but bonds are still volatile, not near as much as stocks. But last year, that F fund was down 2.5% for much of the year, until that fourth quarter when we saw a sell-off in the stock market, and then the bonds rallied. Right? So during that year, you didn't see the G fund go down at all because it can't. Right? So it pays a steady interest income. It will never go down in value. So it's the most secure, safe investment that you can have in the TSP account. So before I screen there, I'm always asked, or often asked, well, how should I invest my TSP? It's a question that's impossible to answer without understanding your full set of financial circumstances, your goals, your objectives, what you're trying to accomplish. There's some rule of thumbs out there. It used to be take 100 minus your age. That's what you should have in stocks, and that's dynamic, right? So as you get older, the less stocks you should have. Then they said, oh, well, we're living longer, so now instead of using 100, we need to use 120 minus your age, and that's what you should have in stocks. Okay. So those are rule of thumbs, but they're guidelines. I encourage you to find someone to talk to, or do your research to determine what's the appropriate mix for you based on your specific set of circumstances, goals, and objectives, and your tolerance for risk. So the L funds try to do some of this work for you. All right, and so rather than you picking individual funds, you can just pick an L fund that most closely corresponds with your retirement date. If you're going to retire in 2032, the 2030 fund would be the fit for you. So here, what you're doing is you're kind of offloading the responsibility of trying to figure out how much money I should have in the CSI, F, and G funds, and you're instead saying, okay, TSP, with your expertise, you compile those funds in the right percentages for me. And that's what they're doing. They're trying to maximize a return for any given level of risk. The basic premise here is that the longer your time horizon, the more willing and able you are to accept risk to achieve a higher rate of return. So they're designed to take that process of picking the funds off of you and to simplify it. Right? They're not designed, however, to prevent losses. Right? So if you looked at last year, look at the performance of the L funds. All stock market indices pretty much were negative last year. Right? So if stocks are going to be down, it's going to be hard for those more aggressive L funds to actually be positive. Right? So they're not going to be. So they're not there to prevent losses, but what they're there to do is to provide you diversification, and then also maybe through that diversification, reduce the volatility, comparatively speaking, just holding a single index or a single fund. So which L fund is right for you? Well, that would be determined based on your target retirement date, as I mentioned. What I can tell you is the wrong way to pick the L fund is to spread your money across several of them, which I see quite a bit. So people think, hey, if one is good, then three is better. I'm going to be more diversified. Well, you're really not, because all L funds are simply allocating to the same 5 underlying individual funds. So by having multiple L funds, you're not increasing your diversification, you're just averaging them out. Now, what may make some sense, and I've seen people do this, is that they say, I'm going to retire in 2045. Right? So the TSP says, okay, well, that should be a 2050 fund. But you say, well, I want to be more specific than that, so I'm going to put half my money in the 2050 and half in the 2040. That's okay. That's going to get you closer, an allocation. To me, I think, going with the 2050 fund would be okay there. But if you want to do something like that, I'm okay with that as well. But when you start going into multiple, 3 or plus of those L funds, you're not doing yourself any favors. You're not improving the diversification at all. That's done with one fund. All right, so how much should you contribute to the TSP? And after I submitted these slides and was thinking about this kind of practice presentation, I realized that there was something else to this that I wanted to talk about. And that was the fact that it's actually possible to put too much into your TSP account. Now, not as a dollar amount, because I just told you earlier on that the contribution limit is fixed, right? It's at $19,000 for those under 50, or it's $25,000 for those over age 50. So we can't put more than that in. However, we can put too much in as a percentage of our salary. And what happens when we do that is we lose out on some of our agency match. So for example, let's take a $100,000 salary. And let's say this person is a big saver, and they love just to get the money into the TSP account sooner rather than later. So they're going to put 25% of their salary into the TSP account. Well, they're under age 50, so their limit is $19,000. So what that means is that they're going to hit that $19,000 limit before their 26th pay period. And in fact, I crunched the numbers, and it's about 19 3/4 pay periods when they hit that $19,000 limit. So what that means is that for those 6 remaining pay periods, they're not making a contribution, and they're not getting that agency match either. Now, they're getting that 1% automatic, but they're not getting that additional 4% match. So if we look at what pay they would receive over the remaining 6 pay periods, it's about $23,000. Multiplied times 4%, they're losing out on over $920 of agency match by trying to do a good thing and put a bunch of money into that TSP. So what you want to do is take how much ever money that you plan on contributing to the TSP, divide that by your salary. And whatever that percentage is, that's what you need to be contributing. So in this example, they want to max. They want to hit that $19,000. Divided by $100,000, they should be putting in $19,000 instead of $25,000. That will ensure that their contributions are spread out over their entire 26 pay period cycle, and that they're receiving agency matching contributions on the entire 26 pay periods as well. Okay, back to our regularly scheduled program in this slide here. So how much should you contribute to the TSP? Well, I too often see people putting in everything that they can spare to save into their employer plan, whether it's a 401k or whether that's the TSP account. The issue here is that yes, it's a great opportunity. It's low cost. We're potentially doing tax deferral. We're saving in some sort of tax advantage plan. However, if things don't go according to plan, it's difficult to get the money out while we're still working for that employer. So take for example the government shutdown that just recently happened, right? And you heard on the news a lot of people, they couldn't afford to pay the bills. They're having to do these predatory high interest rate loans. They're having to borrow money from family. So people are helping out. So they unfortunately did not have enough liquidity outside of their TSP account to absorb, the twists and turns that life inevitably throws our way. So rather than saying, all right, I'm going to save 100% of my savings capacity into the TSP, it can make some sense to split it up between TSP and perhaps like another account like a Roth IRA if you're eligible based on income limits. So for example, let's just say, somebody wants to contribute $10,000. That's what they can afford to save each year. Well, rather than put that $10,000, 100% of it into the TSP, they put enough just to maximize their agency match. So we'll just say, all right, their salary's $100,000 again. They're going to put in $10,000, so 10% is what they're thinking. Well, it might be better to reduce that to 5%. They're maximizing the agency match. They're getting the 1% plus the full 4 match. But now, take that remaining $5,000 and put it into a Roth IRA. What you're doing now is you're creating additional liquidity outside of the TSP that's easily accessible. One of the things we're going to talk about in a bit is that Roth IRAs are a great flexible account. You can actually get your contributions back out day one, penalty and tax free. Right? You don't have to have it in there a minimum amount of time. We're going to go in more detail about that in a second. But let's just say your savings capacity is the $19,000. And you don't have a whole lot of liquidity built up outside of the TSP account. Well, in this example, you want to split that. We can do $6,000 into a Roth IRA, and it's $7,000 if we're over the age of 50. So for somebody under 50, I would say put $6,000 into a Roth IRA, and the remaining $13,000 into the TSP account. We're checking the box. We're maximizing our company match, our agency match. We're, in that case, maximizing our Roth IRA contribution as well, creating liquidity. And then we're putting the additional funds, the differential, into the TSP. So we're checking a lot of boxes here to create a sound financial house to help us weather the storms and the twists and turns that will eventually happen at some point in time. All right, I get this question a lot. So should I do the traditional TSP or is the Roth TSP better for me? So to figure this out, let's start with some basics, and then we're going to go into an example and see how we can figure out which one will be better for you. So first off, traditional TSP, it's funded with pre-tax dollars, right? The money that's in there is growing tax deferred. You don't pay tax on any of the earnings, the interest that those individual funds are generating. Tax comes at the time when you start pulling the money out. And at that point in time, it's taxed as ordinary income. So you add it up with your pension, your taxable Social Security income or other ordinary income that you might have. Subtract out your deductions. You have taxable income. You put that through the brackets, and that's what tax you pay. Compare that to the Roth IRA, or the Roth TSP, rather. Excuse me. It kind of works just the opposite. Contributions go in after tax. Once the money's in there, however, assuming qualified distributions, all the earnings and contributions come out tax-free. And actually, you don't even need a qualified distribution to have the contributions come out tax-free. You've already paid tax on those. So immediately, those contributions will be returned to you when you take distributions, tax and penalty free. It's the earnings on those contributions. In order to get those tax-free, you have to have what's called a qualified distribution. And if you don't, then you're going to pay tax on those earnings. And if you're younger than 59 and a half, in addition to the tax, you're going to pay the 10% early distribution penalty. Required minimum distributions. One thing I'll point out here is that they apply to both the traditional as well as the Roth TSP. All right, so typically beginning the year you turn 70 and a half, you're going to have to start taking required minimum distributions, money out of the plan, whether you want to or need it or whatever. All right, those apply both to the traditional, like I said, and the Roth. Now, if you happen to be working when you turn 70 and a half, your RMD isn't required until the year that you actually retire. So with both the traditional and the Roth, you can contribute $19,000 or $25,000 if you're over the age of 50. And unlike an IRA or Roth IRA, traditional IRA, there are no income limits that apply. Doesn't matter what you make, you can still contribute to the traditional TSP or the Roth TSP. Now, a couple things I want to point out here is that the Roth TSP is not a Roth IRA. Right? So, a couple of the big differences. As I mentioned, the Roth TSP is subject to required minimum distributions. Many of you probably know that Roth IRAs have no required minimum distributions for the original owner. Now, when the original owner dies and if it's left to a non-spouse beneficiary, those non-spouse beneficiaries will be subject to required minimum distributions, but they'll be tax-free as well, assuming qualified distributions. So difference is that there's no RMDs to the Roth IRA, there is to a Roth TSP. Other thing would be in the contribution limits themselves, right? $19,000 for under age 50 or $25,000 if you're over age 50 to the Roth TSP. That compares to $6,000 to a Roth IRA versus $7,000 if you're over age 50. So, and the Roth IRA contributions are subject to income limits, as I pointed out. One other thing is that you are able to convert money from the traditional TSP, a traditional IRA, or some other tax-deferred retirement plan to a Roth IRA. You are not allowed to convert your traditional TSP or a traditional IRA or other tax-deferred retirement plan to the Roth TSP. Okay. You actually can't even transfer in a Roth IRA to the TSP. You are, however, permitted to transfer in an employer plan Roth account. So, for example, if you had a Roth 401k or a Roth 403b, that money is eligible to be transferred into the Roth TSP. All right, so I've talked about qualified distributions. Let's define them. A qualified distribution is one that meets two thresholds. The first is that you have had a Roth account open for 5 years. Okay, and it's not 5 years from the date that you made your first contribution. It's actually 5 years from January 1st of the year you made your first contribution. So if you made your first contribution to a Roth account today, January 1st, 2019 is the starting point for that 5-year period. Okay, you have to satisfy a 5-year rule separately for the Roth TSP and for Roth IRAs. Satisfying one does not satisfy the 5-year holding period for the other. So if you plan on transferring Roth TSP money over to a Roth IRA and you have not had a Roth IRA open before that transfer, you will need to satisfy a 5-year rule when that money transfers over into that Roth IRA, okay, for it to be a qualified distribution. The second threshold or hurdle that you need to jump over is the distribution has to occur after you've turned 59 and a half, or if you were permanently disabled, or if you have died, your beneficiaries may take out that money without being subject to that age 59 and a half requirement. You know, beneficiaries are still subject to the 5-year holding period. That 5-year holding period, though, is not based on when they inherited the money. It's based on when you originally started contributing to that Roth account. Okay. So your holding period carries over to theirs, or to them. All right, so which one's better? Right. And to do that and to illustrate which one's better, I'm going to go through a couple examples. And the first example, I'm going to show, you know, the comparison between the traditional TSP contribution and its future value versus the Roth TSP contribution and its future value, assuming tax rates remain constant. And so let's just assume we're going to contribute $10,000 to the traditional TSP. To be fair, I want to do an apples-to-apples comparison. We know that traditional TSPs are funded with pre-tax dollars. And by the way, one thing I didn't mention is that I'm talking about the federal taxes, you know, taxation of the traditional TSP and the Roth TSP. States are a little bit different. State rules vary widely. There are some states that actually tax you on your traditional TSP contributions, but they don't tax them on the way out. So just bear in mind that I'm specifically talking federal rule here and not necessarily what your individual state rule is. So that's something that you're going to want to look into. So, but here we've got an example where this person's in a 22% tax rate. So do this apples-to-apples comparison. I know that I need to illustrate what's the after-tax contribution going into the Roth TSP account. So after I pay $2,200 in tax, because I'm funding it with after-tax dollars, I'd be left with a $7,800 contribution. So which one's worth more? Kind of a trick question here because they're worth the same, right? $10,000 in your traditional TSP is worth $7,800. Right? Because to take that money or to get access to that money, you've got to withdraw it. It's never been taxed before. So assuming that you're not going to have any 10% early distribution penalty for being under age 59 and a half, you'll pay $2,200 in tax. So you'd be left with $7,800 in that real after-tax value in your bank account. It's the same value as what that Roth TSP is worth day one. And remember, contributions are never taxed or penalized. So day one, you could take that $7,800 out of your Roth TSP, and it is going to be worth $7,800 in your pocket. Okay? So let's fast forward. Let's look at a future value, because what I'll often get is say, yeah, but I took a finance class and I understand the power of compounding, and I know that $10,000 is going to grow more than $7,800. Right? Let's test that theory. Let's assume a 7.2% rate of return. Forget about the return. I just use that because my money doubles every 10 years at 7.2%. So let's not worry about whether we can achieve that or not. Let's just go with it. So what that means is that in 10 years' time, my traditional TSP is going to grow to 20K. My Roth TSP will double to $15,600. So now I want to start pulling money out. And if I can pull money out from that traditional TSP account and I'm still in that 22% rate, I'm going to pay $4,400 in tax, which means I'm going to be left with $15,600. There's no economic difference between a traditional TSP contribution and the Roth TSP, all things being equal. Primarily, that the money gets to stay in those accounts for that period of time that we're observing here, and that tax rates remain constant. Okay? Those things being equal, there's no economic difference. But what happens if tax rates change on us? Right? What happens if instead of remaining constant, we actually see tax rates increase over time? So instead of 22% in the future, we'll assume it's 25%. So in this case, if I still did my contribution at rates were 22%, I got 10 going into TSP, $7,800 going to the Roth. But my future value is going to be different because taxes are going to be different now. So at 25%, my taxes are $5,000, leaving me with $15,000. But because I paid taxes up front on that Roth TSP contribution at 22%, remember, I don't have to pay taxes again. We're assuming that it's a qualified distribution. We're 10 years down the road, so we're assuming that we're also over 59 and a half, so that $15,600 is free of taxes. Right? So in this case, in a rising rate environment, tax rate environment that is, your Roth is going to prove to be more valuable. Right? Well, guess what? What if rates go down? The opposite's going to hold true here. Okay, I'll let the cat out of the bag early. Right? So instead of 22%, let's assume our future rate is 12%. So instead of $4,400 in taxes, we're going to owe $2,400, and our balance then is going to be $17,600 in that traditional. So to generalize, tax rates remain equal. Money stays in the account for that period of observation. There's no economic difference. However, if tax rates are rising, the Roth is going to be better. If tax rates are going down over time, the traditional is going to be better. Right? So why do we worry about this if there's no economic difference if tax rates remain the same? Because reality is a lot of folks, when they go from working years to retirement, tax rates remain the same. We're going to go into a little bit more detail and explain why that may or may not happen. But some things I want to point out here is rarely are things ever equal. So first and foremost, the deferral limit is the same regardless if you're contributing to the TSP, the traditional TSP, or the Roth TSP. So the reality is that you could put $19,000 into the traditional, or if you can still afford to put $19,000 into the Roth, your taxes are going to be a little bit higher, remember, but you can still put $19,000 in there. $19,000 in the Roth is more valuable than $19,000 in the traditional. So you can actually create a larger after-tax balance that's growing tax-free, assuming tax rates are remaining level. If tax rates are changing, we need to change the comparison a little bit. But you can provide a bigger after-tax account there. What we know about tax rates is that the ones we have right now are temporary. Right? Last year, the Tax Cuts and Jobs Act ushered in new tax rates. So it reduced all the tax brackets by a few percent. So I illustrated a 22% example. Well, the 22% was the 25%. That 12% was a 15%. And guess what? Those tax rates, the 22 and the 12, are temporary. Beginning the year 2026, 2017 tax rates come back. So that 22% will go to a 25, and that 12 will go to a 15. So if Congress does nothing, unless they make them permanent, and I don't see them making these lower rates permanent, and even if they did make them permanent, that's only permanent for today, because permanent is really never permanent. They can change the rules of the game at any point in time. But we know tax rates are going to go up in the year 2026. So we're going to be in a rising tax rate environment. So that's something to take into consideration as we're contributing over these years to our TSP plans. The other thing I'll point out is stealth taxes, right? So obviously there's the rate of tax that we pay on our contributions or distributions, but our distributions from the traditional plan is considered ordinary income, and it goes into our adjusted gross income and our modified adjusted gross income, which a lot of these what I call stealth taxes are based on. So think here, how much of your Social Security benefits you have to include as taxable income. That's based on your other income that you have. Traditional TSP distributions included. However, Roth TSP distributions are not included. Medicare Part B premiums are another stealth tax, or something I consider a stealth tax. The higher your income, the higher your Part B premium. Again, Roth distributions do not count in the formula when you're trying to figure out how much income you have to determine those Medicare Part B premiums. There's changes in tax filing status. A lot of people don't think about this, but at some point in time, we all leave this great earth, right? And so let's think through a married couple situation where they're filing a joint return. One spouse dies. That surviving spouse is no longer filing a joint return. They're filing a single return. And what do we know about the joint and the single brackets? Well, you can have more income tax at lower rates than you can single tax rates. So it's often possible, and actually I see it quite a bit, where one spouse dies and they're now filing as a single tax filer. Income is similar, but their taxes actually go up because they're filing as a single tax filer in a more compressed tax bracket. We also need to think about estate planning objectives, right? Perhaps your heirs, your children, are very successful and they're in high income tax brackets. And this is money that you're not going to need. And so, you're going to pass it on to them. Well, if you can pay tax at a lower rate than what your kids would take it out when they inherit it, well, the Roth may be a little bit better. And then I just say changes to the rules, right? Congress loves to change the rules in the middle of the game on us. And so, regardless of whether or not they make the current rates permanent or not, I envision a future of higher tax rates as we're trying to figure out how we afford to pay for our spending as a country and pay down our debt as well. So I think we can, make a good argument that we'll see higher tax rates at some point in time in the future, in which case the Roths could prove to be very beneficial. All right, so should you contribute to the Roth or to the traditional TSP account? So to illustrate this, I'm going to walk you through an example how you can determine specifically for your circumstances which one will be better for you. So I'm going to take an example here. We got Ed and Judy. They're both 55 years old. They file a joint return. Their income is $115,000. I'm going to say that's before they make a TSP contribution, but after maybe some of their pre-tax deductions like medical insurance, things like that. So let's say maybe their gross income is $120,000, they do $5,000 for health insurance, so their gross taxable income, if you will, is $115,000 before any TSP contribution. So let's walk through an example here. They're going to put 100% of that $25,000 into the traditional TSP. What does that impact, or what impact does that have on their taxable income? Well, we start at $115,000. Everybody's afforded either a standard deduction or an itemized deduction. So in this case, we're going to assume the standard deduction, which this year is $24,400. So that's gone up $400 since last year in 2018. So after they take out the standard deduction, that brings their income down to $90,600. Now we're going to say, all right, $25,000 off of that for their traditional TSP contribution. So their taxable income is now $65,600. So what does that mean in terms of taxes? Well, to understand, we've got to figure out, well, what are the tax brackets, right? And so for those of you who missed my tax webinar that I did in January, I encourage you to go back and look at that. I go into detail about how our tax system works, but very briefly, we are a progressive tax system, or the U.S. has a progressive tax system, which means the higher the income, the higher the rate of tax that you pay. But you do not pay that higher rate on 100% of your income. it goes through brackets. So for example, what I don't show up here on this slide is that there is a 10% bracket first. And then for somebody who files a joint return, their first $19,400 in taxable income is going to be taxed at 10%. Every dollar they earn above that, up until $78,950, is now going to be taxed at 12%. So that's about $50,000 there. And then every dollar above $78,950 is going to be taxed at 22% until they get to the $168,400 level. They go above that, the next rate is 24%. So that's how our system works in a nutshell. So if we look here and we can see that their standard deduction and TSP contribution has brought their taxable income down to $65,600, we can see now that part of their contribution would have been taxed at 22% and part of their contribution would have been taxed at 12%. Specifically, $13,350 of that contribution, had they not made it, would have been taxed at 12%, and the remainder, $11,650, would have been taxed at 22%. I don't know about you, but you're going to have a hard time convincing me that this couple is ever going to be in a lower bracket than 12%. So I already mentioned that 12% and 22% are temporary, right? Beginning of the year 2026, they're going to go up to 25 and to 15. So I don't think that they'll ever be in a lower bracket than 12%. And what we know is that even if tax rates remain level, worst case scenario, there's no economic difference between the traditional and the Roth. But no, things aren't equal. Remember, traditional TSP has required minimum distributions. While the Roth TSP does as well, there's always the option to transfer that Roth TSP to a Roth IRA. That way you do not have to take required minimum distributions once it's over in the Roth IRA. So in other words, it gets to stay there for your entire lifetime. Whereas the money that's in that traditional TSP, even if you want it and push it over to a traditional IRA, you're going to be subject to required minimum distributions beginning at 70.5. And let's just say you're not spending those required minimum distributions. So you're just banking them or you're investing them. But now that account that those required minimum distributions are going into is making a little bit of money, and you're going to have to pay tax on those earnings that money is making, right? So that when we look at the value of the combination of your TSP and this account that you're building up with your RMDs, the combined value is not going to equal the future value of that Roth account, right? Because of the impact of taxation on not only the distributions, but the earnings on the money growing forward. So even if tax rates remain the same, we still tip the scale a little bit in the favor of a Roth component or a Roth type of account. So to me, the better thing to do for this client or for this this participant here would be to reduce the amount that they're contributing to the TSP, to the traditional TSP that is, down to $11,650. Redirect that remaining $13,350 to the Roth TSP. So what we're doing is we're intentionally now paying tax on that $13,350, right? And we're deferring tax on $11,650 of income. So we've increased our taxable income up to $78,950, right at the top of that 12% bracket. To me, that's perfect. I have a mantra. It says, I say we want the highest possible income in the lowest possible bracket. I'd rather pay 12% on this 13 grand today, and in the future, when that 12% becomes 15% or even higher, pull the money out tax-free. It doesn't make sense to defer tax today at 12%, and then have to pay tax in the future at 15% or perhaps even higher. What happens if these retirees, Ed and Judy, are in the 22% throughout retirement, which is quite possible. I see that often. A lot of times people, they think that their tax rate's going to go down in retirement, when in reality it doesn't. When you figure that they have pension income, Social Security income, TSP withdrawals, they have lower deductions than they used to when they had mortgages and things like that. So oftentimes tax rates remain constant, from the point of working years and into retirement. So sometimes it makes sense to intentionally pay the tax. In this example, it makes a lot of sense. So every year you need to do this analysis. It's not a one-time decision. Every year you need to look and estimate what your income is going to be for the year so you can figure out what impact your TSP contributions will have on that taxable income and ultimately your taxes to determine which route is better for you. All right, so we've got money in the TSP account. Now we want to get access to it. We need to access it. Well, as I mentioned earlier when we were talking about building a sound financial house, it's difficult to access your TSP money while you're still employed. Now you can, it's not impossible, I just said it's difficult, right? So there's a few different ways that you can do it. One is through a loan, and there's a couple different types of loan. You can do a general loan or a residential loan. The residential is when you're buying a home, and so you're allowed to have a longer payback period. There's a hardship withdrawal, which you have to meet one of these requirements up here, recurring negative cash flow, medical expenses that you haven't yet paid, not covered by insurance. You have to prove this hardship to be able to take this money out. And then there's an in-service withdrawal, which is you're still working, you've attained age 59 and a half, and now you can take money out. Okay, so but in none of these cases is it quick, right? And so I use that government shutdown as an example. By the time that the government shutdown ended, you might have gotten money out through one of these methods. So it's not, quick that you can get this money out. You can do it, but and all of them have their pros and cons, right? The advantage to a loan is that, well, you're not generating a taxable transaction. And you're paying yourself back the interest that you owe on the loan. The downside, though, is that, one is opportunity cost, right? That you've pulled money out, now it's no longer they're earning money. The other thing is that, you're required to make repayments, so depending on your cash flow, you may or may not be able to do that. Hardship withdrawals, obviously you're pulling your money out and that's it. You can't get the money back in. And so you're going to pay taxes to the extent it's a traditional distribution. And if you're under 59 and a half, you're going to pay a 10% penalty. So some pros and cons there to be concerned with. And if you take a distribution prior to 59 and a half, as I mentioned, there's a 10% early distribution penalty that we need to be aware of. There are a couple exceptions to this. One, as I mentioned earlier, death, right? You pass away, you leave your money to a beneficiary. Beneficiaries may always take that money out penalty-free. Okay, remember, that's the penalty applies to an early distribution. It's 10%. With the Roth account, as I mentioned, you still have to have a qualified distribution to have those earnings tax-free. So if they haven't met that 5-year holding period, they'll be taxed on any Roth earnings that have been distributed. They just won't have to pay that 10% early distribution penalty. The other one that I want to point out is the age 55 and retired exception. So this is when you work until you're age 55, retire. You are then eligible to take money out of your TSP account. You'll pay tax as appropriate, but you will not be subject to the 10% early distribution penalty. Now be mindful that you have to retire in the year you turn 55. You can't retire at 53 and then simply delay withdrawals until you've reached 55. You actually have to retire in the year that you turn 55 or later. And then there's actually an age 50 exception for certain federal public safety employees, so it's even lower there. The education, the first-time home buyer, the unemployment reimbursement of health insurance premiums, those are specific to IRAs only. And then the age 55 exception is specific to employer plans only. So I want to point out that if you retire at age 55 and then transfer your TSP to an IRA and start taking money out of the IRA, expecting to get that age 55 exception, you're going to be out of luck. You've lost it once you've transferred that money out of the TSP over into an IRA account. So be aware of that. If you're retiring and plan to take money before 59 and a half, make sure that you keep enough money in that TSP account to draw down from so that you're not going to incur any 10% distribution penalties. All right, so now we've separated from service. What are our options? Well, today, currently, we can either take a partial withdrawal or we can take a full withdrawal. The partial withdrawal is a one-time deal, right? If you've taken a partial withdrawal once, that's it. It's once per lifetime. That even applies to in-service withdrawals. If you took an in-service withdrawal, retired, you cannot take a partial withdrawal. Your only option now is to take one of the 4 full withdrawal options. Now, full withdrawal is a little misleading because one of these options is, periodic payments, monthly withdrawals. Right? In my opinion, that's not a full withdrawal. We're simply taking monthly payments, right? The rest of our money stays in the TSP account. And it's actually created quite a bit of confusion that they're addressing with these new rules. So your options are single payment, monthly payments. That can be either a specific dollar amount that you set, or you can check a box on the TSP form and have them base those monthly payments on life expectancy. You could transfer all or part of your TSP to an annuity and receive lifetime income, depending on the options that you choose there. And then the final one is a mixed withdrawal, which is a combination of 2 or more of those first 3 options. So for example, you could take a single payment and have it paid directly to you, or transferred to an IRA, and then also set up monthly payments at the same time. All right, a little more detail on the current rules, and that is specific to these monthly periodic payments. As I mentioned, you can have a specified dollar amount or based on life expectancy. Once you've started monthly payments, under current rules, you cannot stop them. You can reduce your monthly payments if you specified the dollar amount to as low as $25, but you can only do that once per year. That's usually toward the end of the year during the annual change period. And actually, the new rules are going to be in effect before the next annual change period comes into play. So if you've got monthly payments that you're receiving now, you're not going to be able to change them until the new rules go into effect. So the other option, based on life expectancy, you're allowed a one-time change over to a specified dollar amount. Again, that has to be done at the annual change period. There's this thing called a withdrawal election deadline, which says you must elect a full withdrawal option by April 1st of the year following the year of death. I'm sorry, not death. April 1st of the year following the year you turn 70 and a half. Sorry about that. So this has created a lot of confusion. Because again, it kind of goes hand in hand with that. It says you have to elect a full withdrawal option. So people misinterpret this to believe that they actually have to take all their money out of the TSP account, when that is not true. Monthly payments are one of your full withdrawal options again, and you just have to elect that by April 1st following the year that you turn 70 and a half. A couple other things is that when you do take a withdrawal, they come proportionally from the traditional and Roth balances. So if you had 75% of your balances in the traditional, 25% in the Roth, the distribution that you take will come 75% traditional, 25% from that Roth balance. Withdrawals come proportionally from investment funds. I know there's a lot of people out there, me included, that would like to specifically say which fund my money comes from. If stocks are down, I may not want to sell my stocks. I may want to take my distribution from the G fund or the F fund instead. You cannot do that because the TSP says they're going to come proportionately from all the investment funds that you own. There's some workarounds with that we're going to talk about here in a second. So now to the new rules. The new rules, first thing, they do away with that withdrawal election deadline. So they're going to clear up a lot of confusion. They've recognized that this has created, a mass exodus from the TSP account at that time frame, because people think they need to take out a full withdrawal in its entirety. So, which point out you do not actually. Multiple partial withdrawals are going to be allowed. So even if you've made a partial withdrawal already, once the new rules go into effect, you will be allowed to take multiple partial withdrawals from that point going forward, up to once per month. Periodic payments, they're enhancing those as well. Rather than just having monthly as an option, you will now have annual and quarterly periodic payments as an option as well. And when you do start those periodic payments, you can change the amount at any point in time. You can even stop them altogether. Another cool thing is that if you're receiving, let's just say, monthly payments, and you go buy a car and you need some additional money for a down payment, well, you can take a partial distribution in addition to that periodic payment and use it for that down payment. So that's a pretty cool feature. So one thing I want to point out is that it doesn't matter what you've elected, and I'm gonna put an asterisk to that comment here in just a second, with the exception of an annuity. But if you've elected a monthly payment, or if you've taken a partial withdrawal, when those new rules go into effect, you're going to they hit the reset button. You're going to be allowed to do multiple partial withdrawals from that point going forward. You're going to be allowed to change your existing periodic distribution, so you have a lot of flexibility there. I put that asterisk on there because if you've already elected an annuity and that annuity is paying out, you can't unwind that. Once you've elected that annuity, that's it. You're stuck with it. Obviously, if you've taken a single payment and cashed out your TSP account and no longer have a TSP account, they're not going to let you, back in unless you're currently employed and making contributions. So that's the asterisk. So you're also going to be able to direct, specifically which balance you want your distributions to come from. So you can say, all right, I want this to come from my traditional IRA, or traditional TSP, excuse me, or I want it to come from my Roth TSP. So that will allow those of you who want to keep that money in your Roth account for as long as possible to do so. Again, up until the point where you're subject to required minimum distributions, and at that point in time, you're going to have to take money out of that Roth TSP if the money is still in there. What it does not change is that the fact that your distributions will still come proportionately from the various investment funds. So the new rules do not change that. I do think that might be something that's considered in the future, though, based on my conversations with the TSP. So that would be another great addition. So while not perfect, the new rules go a long way to improving the flexibility and to I think providing the ability that folks who are TSP participants want and need in their retirement years when they're drawing down from their TSP account. All right, so I mentioned required minimum distributions. Basically typically these begin the year you turn 70 and a half, or when you separate from service, if later. All right. So you are allowed to delay that first RMD to the point what's called your required beginning date, which is April 1st following the year that you turn 70 and a half, or still working, retired. But bear in mind, you're not avoiding that RMD. You're just simply delaying it a year. So what that means is if you turned 70 and a half this year, 2019, 2019 is your first RMD year. You have until April 1st, 2020 to take it. And if you do delay it into 2020, you're still taking 2019's RMD in 2020, which means you also have to take 2020's RMD by the end of that year, by 12/31/2020. Once RMDs start, you're required to take a required minimum distribution every year thereafter by 12/31. Now, I did a estate planning webinar, I think it was back in December, and I talked about beneficiary participants and some of the drawbacks and the rules for their beneficiaries. And it created some confusion, and so I just want to revisit this here to point out that there is a difference between a TSP participant and a TSP beneficiary participant. What I talked about in that estate planning was specifically TSP beneficiary participants. All right, so the difference is a TSP participant is the person who has actually contributed to that TSP account, worked for the federal government, contributed to the plan. Right? A beneficiary participant is a surviving spouse who inherited the TSP participant's TSP account. Only a spouse may maintain a beneficiary participant account. Right? And the rules differ, and this is what I want to point out. When a TSP participant dies, the beneficiaries have some options here, particularly if it's a spouse. Right? That spouse can maintain that beneficiary participant TSP account. In fact, first thing the TSP does when they're notified that the participant died is they push that over to a beneficiary participant TSP account when they see it's a spousal beneficiary. But from that point going on, the spouse can either keep it there or they could transfer it out to an IRA of their own. And at that point in time, they're treated as if they were always the owner of that IRA account. Now, a non-spouse beneficiary cannot maintain a beneficiary participant TSP account. They have to take a full distribution. However, that non-spouse beneficiary, assuming it's a real person, they may transfer that to an inherited IRA, and once that money's in an inherited IRA, they can take required minimum distributions, or they'll be forced to take required minimum distributions, but it'll be based on their life expectancy. They can always cash it out if they want to, pay the tax. Probably not the best thing to do, but they could leave it in there, and just take those required minimum distributions. Now that compares to when a beneficiary participant dies. Remember, that was the TSP participant dying. So now we're going to specifically talk about the beneficiary participant. So the original TSP participant has passed away. The spouse is now continuing on the plan as a beneficiary participant account. Two key rules I want you to understand. One is to do with the RMDs. The other one has to do with what happens when that beneficiary participant passes away. With regards to the RMDs, you have the details up here and you can take a look at these slides, but what I want to point out is that the RMDs, the time that they must begin, is not based on the age of the beneficiary participant, but rather it's based on the age of the deceased TSP participant. All right, so that means that RMDs could be forced even though the beneficiary participant has not attained age 70 and a half. The second thing I want to point out is that when they are subject to required minimum distributions, they are going to be using the single life table rather than what's called the uniform life table that owners or the TSP participant uses. And the difference is substantial. About twice as much money has to come out based on the single table than that uniform table. So RMDs may have to start sooner than if they were the owner, and when they do start, they're going to have to be more than they would be if they were the owner. So it might make sense to transfer that beneficiary participant account to an IRA of his or her own, and then be subject to the owner rules then instead of these beneficiary rules. The other thing I want to point out is when that beneficiary participant dies, so let's just say they've maintained this beneficiary participant account, they have now passed away, they have listed their beneficiaries. It doesn't matter if their own beneficiary was a spouse, let's just say they got remarried, or their children or some non-spouse beneficiary. Their only option is to take a full distribution. And in this case, that distribution must be paid to the beneficiary directly. It may not be rolled over or transferred into an inherited IRA. So in other words, it's going to be 100% taxable, assuming it's a traditional TSP account. That may not be a good thing. Right? So if you have a beneficiary participant account or you're leaving your TSP account to your spouse, this is something to consider and to talk about and plan for. You know, when you pass away and it goes to your spouse may be better off transferring it to an IRA of his or her own, in which case they're subject to all the required minimum distribution rules that any other IRA owner would be subject to. And also when they pass away, their beneficiaries will now be able to transfer that inherited IRA to an inherited IRA, or the money that was in the IRA account to an inherited IRA of their own, and take minimum distributions out, thereby preserving the tax deferral or even tax-free growth, you know, over possibly decades. You know, so just wanted to clarify that from my estate planning presentation. So I just want to take a few more minutes here as we wrap up this presentation to talk about, you know, some of the quirks and of the TSP and ways to perhaps minimize them. You know, and the first thing is this proportionate distributions from the investment funds. As I mentioned, you know, a lot of people want to specifically take their distributions from one or more funds instead of proportionately from all their funds. Well, when the new rules go into effect and we can do multiple partial withdrawals, it's not ideal, but a workaround until hopefully at some point in time they allow us to direct distributions from specific funds. But until then, what we can do is maybe take a partial withdrawal, you know, the amount that you think you're going to be taking out on an annual basis, and have that transferred to an IRA account. You know, once it's in the IRA account, you could invest it similarly to the TSP account, or you could selectively have it just held in a certain type of fund. But now you're directing when and where that money is coming from when you take a distribution from the IRA account. And then what you would do is you rebalance that TSP account right after you make that distribution and transfer it to the IRA. You're going to rebalance that TSP account to whatever way is necessary so that the net effect is that you took that withdrawal from the specific fund that you wanted to take it from. We know that we have limited withdrawal options currently with the TSP, but we also know that it's short-lived here. We're getting closer every day. You know, within about 6 months or so, we're going to see the introduction of these new rules. But for those folks who need to take money between now and then, you know, and they're finding that their options are limited and don't quite fit their needs, there may be some workarounds to consider here. You know, if you have not taken a partial withdrawal, you know, and you need some money, and maybe you're just not sure how much money you need. You know, I never like to take more money out of a traditional tax deferred plan than we might need, right? And so, unfortunately, I hear people say, okay, well, I'm just going to take $50,000 and have it sent to my bank account. And I ask them, well, how much do you think you're going to spend? Well, maybe I might only need $30,000. Well, you're taking 20 more than necessary, which means you're paying tax on 20 more thousand than necessary. So rather than just take it out of the TSP and transfer it directly to your bank account, you know, transfer it to an IRA account. Continue that tax deferral. Once it's in the IRA, you can take withdrawals as needed, and only how much you need, so that you're not paying tax on any more money than necessary. And then when the new rules go into effect, as long as you had at least $200 in that TSP account, it will remain open. You always have the option to transfer that IRA money, that traditional IRA money, back into that TSP plan. You know, let's say you've already taken a partial withdrawal, and you need some money but you don't really want monthly withdrawals, but you need a cash infusion. And these new rules haven't gone into effect yet, so one option would be to do a mixed withdrawal, where you could take a single payment, it's a lump sum amount, it could be for a portion of your TSP account, transfer that to an IRA account, and then set up monthly payments for as little as $25. So yeah, you're going to have some money coming in, but it's very minimal. Now we've got a chunk of money sitting over in that IRA account to which you can tap and withdraw as necessary and as needed. Again, once those new rules go into effect, you can simply transfer that traditional IRA money back over into the to the TSP account. Right? So, it means a couple extra steps, but we're just doing some workarounds here to get us from this point in time today to the point in time where the new rules go into effect. We've got a lot more flexibility. We can take partial withdrawals, one per month, as needed, and we're really minimizing the negative impacts here. I get people complaining about, hear complaints about the limited investment options in the TSP, which bear in mind, the amount of money that you pull out of the TSP, it's never all or nothing. Right? One of the great things about the TSP is it is low cost. So if you're picking funds, and you might want to keep, some money at the TSP, gain exposure to the asset classes in the TSP, and if there's some other asset classes that you want to invest in that's not in the TSP, transfer enough money over to an IRA account, use that IRA money to get exposure to those asset classes you want to. So use it in a combination. You don't need to move all of your IRA or all your TSP out over to an IRA to accomplish your investment objectives. Sometimes the answer and the best solution is a portion of it. And we already talked a little bit about the Roth TSP RMDs. The important thing here to remember is that if you do not want to ever take money out of that Roth account during your lifetime, you're going to need to transfer the Roth TSP to a Roth IRA. When the new rules go into effect, you can specifically say, I want only my Roth money to come out of the TSP over into a Roth IRA. It's important that you do this no later than the year before you turn 70 and a half if you don't want to take any money at all out of that Roth TSP account. Because once you've hit that year that you turn 70 and a half, you can still transfer the money from the Roth TSP to a Roth IRA, but when you do so, the TSP is going to calculate what your required minimum distribution is on that Roth balance. They're going to send it out to you, and they'll transfer the net amount to that Roth TSP. So just a couple workarounds, given the limited options with the withdrawal rules that we have, maybe minimizing some of the negative impacts on the Roth TSP, which really don't apply until we get to the point of required minimum distribution age. So that's it for today. I appreciate your time. I recognize that everyone's busy, and so I do appreciate you taking the time out of your day to join me. Again, immediately following this, we're going to go to a live Q&A, and I'm going to answer as many questions as I can. Bear in mind, I'll probably get over 1,000 questions, so I'll try to answer as many, but I'll probably get to a fraction. So once again, thank you. I appreciate your time. Have a great day.